right, everyone. Thank you very much for joining us today. My name is Corey Daharsh, and I am joined by Paul Sr. with Cash Flow Champs. And we are here to bring you this webinar on understanding key investment metrics for multifamily syndication deals. So today, again, our presenters are myself with Advanta IRA. I'm Corey Daharsh, been with the company for about 6 years now, both serving as a client account manager and a business development specialist. My contact information is here on the screen. You could reach out to me via email, via phone call, or connect with me on LinkedIn if you'd like to learn more about either myself or Advanta. And again, my guest of the day is Paul Sr. He is a managing partner with Cash Flow Champs. He is responsible for investor relations at Cash Flow Champs. I've got his contact information there, just the same, his phone, his email address, his website, and his LinkedIn. And I also wanted to reference that Cash Flow Champs is also hosting a virtual summit in about a month. The dates specifically are November 18th through 20th, and that is for any investors that are looking for some great educational content on syndication and multifamily investing. You could check that out at cfcsummit.com. Paul, thank you very much for joining me. Anything you'd like to add real quick?
Just want to say I'm very grateful for the opportunity to be speaking with Advanta IRA today, and particularly to you, and for having us here hosting this webinar.
Well, thank you very much. I know one of your fellow managing partners, Charles Seaman, has joined me in the past. I'm a big fan of Charles and a lot of the educational content he brings. So always happy to help you guys boost your signal however we can and help Cash Flow Champs continue to grow and thrive in the industry for sure.
Really appreciate that. Really appreciate it, Corey.
Yes, sir. So today's agenda is that I'm going to cover at the top some information about Advanta IRA and relating to multifamily investing. I'm going to jump into a quick case study on how to place a syndication investment with a self-direct account. And then I'm going to turn over to Paul, and he's going to cover some ins and outs on prospecting deals, good or bad, for syndication investing, and those key multifamily metrics that you're going to want to know if you don't know, and just how to better understand some of the terms you may be hearing as you're in conversations discussing multifamily investing. Some of the things that if you know briefly and just need a better understanding of, that's what Paul's here to bring for you. And then once Paul is done with his portion of the presentation, we are going to answer any questions that you may have his contact information up again, and kind of come to a full conclusion at that point. So please keep in mind all the attendees here live are muted, so that Paul and I can get through our presentation. We will be holding all questions till the end. So if you're looking at the GoToWebinar window, you should have a little box there labeled questions. Go ahead and drop those in. Add them in as you have them, and we will answer them accordingly at the end of the webinar. So just so we're getting through everything and answering everything, please do not forget to post the questions as you come up with them, so that we can address them all at the end. A little bit about Advanta IRA. We are a self-direct IRA administrator specializing in alternative asset administration. We've been in the industry for about 20 years. We've got just under 10,000 active clients right now and just over $2 billion in assets under management. All of the funds that our clients hold that are not actively invested are insured up to FDIC limits. And one of the other things, aside from the educational components that we put out, that we do to stand above other companies in our industry, is we pair each client we have with a dedicated client account manager, so they get a concierge style level of service from us, where they're calling one person in our office that's their main go-to person for any questions they have, concerns they have, compliance regulation questions, or even processing their transaction. Again, I served in that role for about 5 years, processed thousands of transactions for my clients, and it really gave me a well-rounded perspective on what people need from a client account manager and from an asset administrator, and also what their styles are for investing. So I've seen everything under the sun that someone can hold in a retirement account, either asked about, processed, or physically executed in a time frame that I've served in that role. It allowed me to switch over to this education-based role and really help you guys learn more about what's available and what's out there from an investment standpoint. Now, before we get too far into the presentation, it is important I share this disclaimer. Advanta does not provide any tax, legal, or financial advice, and all of the information that myself and Paul are conveying here is for educational purposes only. We implore you to do your own due diligence and always consult with your own attorneys, CPAs, financial advisors before you engage and enter any specific investment. Now, self-directed investing has been around for a long time, but not a lot of people know about it. That's pretty common when you have a larger wire-based or income-based custodian that's a fiduciary. They typically don't want you to know about self-direction, so they don't provide too much education about it because they have a vested interest in you keeping your money in their fiduciary responsibilities, investing in tax bonds and mutual funds. The retirement account industry in general, as of the first quarter of this year, 2022, had about $37 trillion in IRAs, 401ks, and other various retirement products in the US. To put that into perspective, it was actually 39 trillion at the end of 2021. And again, only about 4% of that money is being utilized in self-directed investment strategies. So key portion of what we do at Advanta is try to provide as much education and network as much as we can to let people know that this is even an option. And if it fits for you or it fits for someone that you know, that you have the ability and confidence to move forward with the self-directed strategy and attain your retirement investment goals as best you can. There are a number of different types of plans that can be self-directed. Most people are familiar with the standard traditional and Roth IRAs, but if you're a small business owner or self-employed, there's also SEP and simple IRAs and also a solo or individual 401k plan. Any previous employer's 401k that you have, so if you've left an employer and you had a 401k with them, that is real simple money to move over to a self-direct account. There's no tax consequence for moving that money. And for other contexts, that money's usually just sitting there in a bucket waiting for you to do something with it anyway after you've left that employer. Other plans that can be self-directed that not a lot of people are familiar with, or if you are, just may have not known that you can self-direct it, are health savings and education savings accounts. If you have a high deductible health policy or you've got a young one in your life that you'd like to help prepare for either their preliminary education or college and after high school education expenses that they may come up against later on in life. So why do people choose to start self-directing? Well, the three key components that we see on a regular basis is the tax benefit. So your investments continue to grow either tax deferred or tax free without capital gains or other types of taxes that would apply if you made the same investment with your personal savings and money. The fatigue in the stock market, a lot of people are feeling that right now with the stock markets going up and down. Getting out of stocks, bonds, and mutual funds with your tax sheltered money and getting into asset classes that you're more familiar with, whether it be multifamily real estate like we're discussing today, or other alternative investments like precious metals, cryptocurrency, hard money lending. There's really a number of different things you could get into in a self-directed strategy, just depending on what you want to diversify with. And then also new source of capital. If you're already an investor, already have a specific expertise, and then you learn from a self-direct webinar educational component that you can tap into that money for the investments you've already learned how to do. It's a new source of capital and a new way to add more money into those strategies that you're more familiar and you're more comfortable with. So why are IRAs and 401ks a good source of capital when you're talking about making alternative investments? Well, it's very easy to do a repeat investment. So in this scenario, let's just say you do make an investment with Cash Flow Champs and it turns out well, you really liked the process, you really liked the communication with their investor relations team. You can very easily turn around and redeploy that money into the next deal in a very simple process without having to go to an outside approval or get overhead clearance. You as the account holder make all of the fiduciary responsible decisions for your own retirement account. If you're not expecting to use the money anytime soon, why not put it into a self-direct strategy and let it kind of be a part of a syndication deal, earning you mailbox money when you know you're not going to retire and tap into that money in the near future anyway. And then better returns. You typically see a lot better returns in alternative investments. Again, that's part of your due diligence. So make sure that the actual asset you're considering does have a better return status than other assets you have at your availability. But when you're comparing the standard money market accounts, CDs, and some of the fluctuation in the stock market, you're likely to get better returns if you're prospecting and doing good due diligence on the deals that you invest into. Now, I did mention it with a previous employer 401k. It's very easy to move money from another account that is not self-directed into a self-direct account. Usually, there's no taxable documentation that even occurs if you're moving as a custodian to custodian transfer, meaning one type of account to the same exact type of account with another custodian. But you could also move from a previous employer 401k or from one type of account to a completely different type of account, like a 403b into an IRA or other type of plan changes like that. It does generate some taxable reporting, but as long as the amount that you distribute out of the first plan is the same amount that you roll into the qualified self-direct plan, there is no taxable event, and those items wash each other out on what's reported by the residing custodian and the new custodian on Form 1099-R and Form 5498. If you had a specific interest in knowing those exact documents that are reported to the IRS, that is what they are called. Now, as I've mentioned before and alluded to in our disclaimer, it's very important to invest with people you know as you're finding deals. So I don't know if many of you are already in networking groups for your investment purposes. There's a lot of great resources out there, whether it's your local RIA group or going on Meetup or LinkedIn to find different groups and different like-minded investors. We try to facilitate some of this networking ourselves. Above and beyond that, like I said, check out your local RIA group, check out your LinkedIn channels and your Meetup channels for different groups in your area that may be great. There's a lot of them out there and a lot of good networking to be had, so you can really invest with people you know as opposed to just finding something that was a sponsored ad and looking into that from there. Now, the last portion I'm going to cover here on today's webinar is a brief case study on how to invest into a syndication deal with a retirement account. And once I wrap that up, I'm going to turn over to Paul for his portion of the presentation today. So my case study, again, is just investing into a syndication deal. I've got an investor who his name is Larry. He's got about $50,000 in a managed IRA account over at Vanguard. He meets Malcolm, who has a syndication offering for a local apartment building. So Malcolm provides Larry the subscription agreement and the prospectus. The minimum investment is $50,000. Malcolm does his portion, Larry does his due diligence, and they agree that Larry decides he does want to make an investment at $50,000. So Larry opens up a self-direct account with Advanta, completes a transfer request form as part of his application. We submit that over to Vanguard to get the money moved over, and we also work directly with Malcolm to collect that subscription paperwork, get the approval from Larry on everything, and execute the transaction, which I'll cover here on the next slide as well. So the process is that the account manager coordinates directly with Larry and Malcolm to get the approval of everything and execution of all the paperwork in the name of Larry's retirement account, tied through Advanta's trust tax ID number, not Larry's personal social, for tax purposes. Advanta, as the custodian and administrator of the retirement account, execute all the subscription documents and sends out the funds to Malcolm and his partnership team. And from there on out, the way that this example plays out, Malcolm's partnership pays an 8% preferred distribution to all subscribers. And in the 5th year, the project's refinanced, and Larry's retirement account receives a lump sum of $65,000 as the final payout for his $50,000 investment. So through the course of those 5 years, Larry's IRA had earned $20,000 in preferred distributions. That's the $4K a year times 5 years, plus the $15,000 profit at the end. generating a total of $35,000 of either tax-deferred or tax-free income that is not subject to capital gains or other taxes that may apply for a personal investment because it's been done through his retirement account. And again, keep in mind, if that money, that $50,000, was in a Roth IRA or a Roth 401k for that matter, it is completely tax-free. He will not have to pay taxes on the back end when he distributes this money out of that retirement plan later in life in his retirement. So it's important to think about passive versus active investing. All investment strategies that someone does in a self-directed account should be passive income. There is active investments you can make, but you do have to generate passive income by them. So if you're holding a rental property or rehabbing or wholesaling, those are things that you make decisions on, but you can't necessarily do the actual sweat equity and labor for. When we're talking about syndication investments or private placements like we are today specifically, those are more passive, where you're putting up your money and there's actually a limited partner position that you're holding as a retirement investor, and there's a general partnership team like Cash Flow Champs and other syndicators that actually do the day-to-day maintenance and handle all of the investment that is taking place, just sending you the proceeds from the money that you've put up for the transaction. So consider yourself, what type of investor are you, and what investment strategies are you familiar with and comfortable with? So just to wrap up really quick, we do have a lot of educational content we put out. If you're viewing this webinar, there's plenty other like it on our YouTube channel. We also have a blog if you're interested in retirement account industry news. And if we're in your local area, which would be Central Western Florida, Western Central Florida, the Tampa region, Atlanta region, and I'm actually in Western North Carolina myself, but I do a lot of networking in Eastern Tennessee and also over in Charlotte and some parts of Virginia. We probably have an in-person event coming up near you, or are networking at an event coming up near you. So reach out and let us know if you'd like to meet up with us in person or participate in any of our other educational content. The final thing I'd like to offer to everyone here attending is we do a networking event called Pitch, Promote, and Prosper, where every other Friday you are able to sign in and have basically the floor of all of the attendees to speak to and say who you are, what you're looking for, or what you have to offer from an investment perspective. And this is a collaborative network of investment providers, clients of Advanta, that all have a like-minded goal of setting themselves up with these investment transactions, whether it be for retirement or for their own syndication deals. We really try to facilitate a collaborative environment for everyone to participate in. It's real easy to start an account with Advanta. It only takes about 15 minutes to complete our application. Moving the money, as I said, is usually not a tax consequence, and unless you're choosing to do a Roth conversion of the money coming into the self-direct plan. And typically starting to invest is a really quick process. As a conservative estimate, I see most clients get their account open, funded, and ready to fund their first transaction within about 10 to 14 days. There's a number of different investments you can make. Feel free to reach out to me if you have any questions or you'd like to learn more. And with that being said, I'm going to turn everything over to Paul, who's going to start his part of the presentation, explaining to you some of the key investment metrics when you're looking at multifamily syndication deals. Paul, the floor is yours.
Hey, Corey, I want to thank you so much. And also thanks to Advanta IRA for the opportunity to participate today in this webinar. I just want to take a second again and just to highlight that we do have a virtual multifamily summit that's coming up in November 18th, 19th, and 20th. It is going to be a great one. It's going to be a great value add to your audience and to just anybody in general who would like to participate in multifamily syndications. If you're starting out or if you're a seasoned investor, we're going to have someone there for you. We have the very best speakers across the country that's going to be there at the summit. It's a virtual summit, so you can do it from the comfort of your home. We have the likes of Dan Hanford, Trevor McGregor, Jake and Gino, Rod Cleef. We had Neil Bawa, Rob Beersley. So all the bigger names in the industry. I would like for you guys to participate in that and just to learn about the multifamily space. Would appreciate that. So as one of the managers of Cash Flow Champs working in the area of investor relations. We consider it a great privilege to speak to the Advanta's regular audience here today and to everybody listening in general. The topic for discussion today is understanding key investment metrics for multifamily syndications. One of the primary reasons for understanding key investment metrics is to answer this question: is this multifamily deal good for me? So if you're going to be out there looking at deals, there's going to come a deal that you come across that you have to analyze, and you have to find out whether or not that deal will work for you. Sometimes you have to go through tens of deals or dozens of deals rather to find the one that will work specifically for you. And to do that, you want to make sure you understand the key investment metrics that has to be taken into consideration. So we'll be touching on some of those today. We'll be touching on capitalization rate, cash on cash return, equity multiple, DSCR, IRR, which is internal rate of return, AAR, which is average annual return, and if we get to it, talk about the yield on cost. So this is stuff that can be boring, so I'll try to get through it. Please get your questions ready and be able to answer those questions at the end. That way we make sure that we provide value for you today. There are key investment metrics that are indicators to whether or not they give multifamily investment opportunities worthy of your investment dollars. Real estate in general and multifamily properties in particular has been a solid investment options for many investors. And real estate has produced more millionaires in the US than any other asset class. But unfortunately, there are people who have also lost money in a big way in the real estate sector. So it therefore begs the question, how can one evaluate a real estate investment opportunity and make a determination as to whether or not this is a good or bad investment for them? First, there are no guarantees for a positive return on investment in any real estate syndication. Real estate investment, like any other type of investment, has a measure of risk associated with it. There's a built-in or inherent risk in any real estate investment. However, there are some metrics that can serve as a guide in selecting the right property as an investment vehicle. So most of the key metrics of multifamily investment can be determined through a process called underwriting. So having a good handle on underwriting is important. So let's just spend a few minutes here on the concept of underwriting. What is underwriting? Well, it is many things combined, right? Underwriting is a gathering of financial information or data about a property. It's also making assumptions of future performance of the property. What you're actually doing too, you're building in projections of income, expenses, and investment returns, also known as the pro forma for that property. And you're doing that so that eventually you can assign a valuation to the property. So when we're saying that we're going to be gathering financial data on the property, what are these financial data that we're talking about? Well, for one, you want to get the property's T12, which is the trailing 12 months of income and expenses financials on that property. It shows that the property previous 12 months of operations. That's a very important piece of data to get. You also want to get your rent roll and any real property taxes on the property. And most brokers generally have an offer memorandum. So those are some of the financial data that you want to gather. In the offer memorandum, the broker will explain in there just a variety of information that will be very helpful in terms of you making an analysis. We're also going to be making some assumptions we reference, and normally you will make assumption in terms of the rent growth that will be happening, and you probably make a projection on what the capitalization rate will be, the terminal cap rate when you're going to exit the property. So when you put in the financial information gathered into an Excel spreadsheet or some type of underwriting model, will help you to analyze the data and to really assign a valuation to the property. So why is underwriting important? Well, the key reason of underwriting is to determine the value, like we mentioned, or the price of the property. And that's based on the targeted return of the investors or even the sponsors who are going to be operating the property. You also use underwriting to create sensitivity analyses, right? With these sensitivity analyses, we can better evaluate possible upside or downside of the investment. Thirdly, it helps to prevent you from making foolish or emotional decisions based on just the beauty of the property or the appearance of the property. So it's important to underwrite a property well so that you can work mostly off the numbers. Underwriting forces you to look at the numbers, and the true real estate investors knows that the value of any asset comes down to the numbers, the price you pay for the property, and the returns that you're getting on the property. So we talk about there are different types of key investment metrics in multifamily. So we're just going to touch on a few of them here today. And if any questions are generated, just put them in the box, and then in the chat box, and we'll try to address those, at the end or somewhere along the way. So what is cap rate? Let's talk about capitalization rate first. Capitalization rate, abbreviated cap rate. The cap rate is the asset's unlevered return. And by unlevered, we mean there is no mortgage on the property, right? So it is a rate of return on your investment if you were going to purchase the property for all cash. So it's important to note that the cap rate does not take into consideration a mortgage. There's a formula that goes with cap rate, and it's a very simple one, and it is the property's NOI, or net operating income, divided by the value of the property. And by the net operating income, we mean that all the money you collected, which is the gross income on the property, you take away the operating expenses, and that will give you your NOI, or your net operating income. The operating expenses does not include debt service, and it does not include capital expenditures. So a capital expenditure is maybe a one-time expenditure that you may experience throughout the year. So if you, for example, replace a roof on the property, or if you did the parking lot, stripe the parking lot, things like that, those may not happen more than once a year or once every 3 years or whatever that may be. Those are considered capital expenditure. That's not a part of your net operating income. So typically your expenses for your operating expenses would include something like payroll or contract services, repairs and maintenance. You may talk about administrative fee, taxes and insurance for sure. So calculating your cap rate, you have to know what expenses should be associated with that, and that's normally your operating the expenses that help you to operate the property on a daily basis. So cap rate is a measure of the risk and the return of an investment. So a property that has a low cap rate, for example, like between a 2 and say a 4%, that would mean that the asset is lower risk and it has a higher value to it. And on the flip side of that, if you have a higher cap rate, like something that is 10% or above, it will reflect a lower price with a higher risk associated with that property, and possibly higher returns as well. So you will find that property that has low cap rate, or in areas that are more desirable, major town, major city, and places that is very welcoming for people to live there. We'll probably call those more like A-class assets, right? So a property with a higher cap rate is more like a C-class asset. So the cap rate will give you an idea of the demographic that you're dealing with. So how is cap rate used? Well, we use cap rate to track trends in the market. We also, buyers use cap rate to determine if they're getting a deal on the property they're looking to purchase. Brokers and sellers alike, they use cap rate as a sales tool to attract buyers to their property. Another use of cap rate is that with a cap rate as a metric, the buyer can use it to compare the price of an asset in the market with other similar properties that have recently sold. So as an example, we can look at a cap rate example here. Let's look at this one. A buyer is interested in purchasing an apartment building with 100 units, each earning $1,000 a month in rent. The property annual operating expense is $200,000. So if the cap rate is 7%, what is a reasonable price for the property? So based on what we just said, what we want to do first here is just to calculate the net operating income. We know that the net operating income is the gross income minus the expenses. So the gross income we have here is $1,200,000. And we get that by just multiplying the number of units times the price per rent for each unit, which is 100 times 1,000, that's 100,000. And we annualize that. So we multiply that by 12. And once we take out the expenses out of it, which is $200,000, then we have a net operating income of $1 million. So here you can get the valuation, the amount you think you should pay for the property, right? So the property value is the NOI divided by the cap rate. We know that the net operating income right now is $1 million, and the cap rate that we are working with in this, the market cap rate is 7%. So if you divide $1 million by 0.07, then you're looking at $14.28 million. So it gives you a good idea as a purchaser what you should be paying for that property. So if that property is listed on the market for $16 million, then you know that property is overpriced. So based on the information that you've gathered here and your analysis, you do have a ballpark as to where you should be paying for that property. Now, if that property, is on the market for a lower price than that, then you want to take action on that property right away. So it does give you a good idea in terms of how to make an offer on a property. We're continuing how to use cap rate here, and we'll just make reference that it helps you to determine if a refinance of your property is possible. If you know the property's value based on the NOI and the cap rate of similar properties in the area, then you can calculate you can determine the potential loan amount based on what the lender's LTV is. LTV is loan to value. So normally most lenders will have an LTV of 70 or 75%. So by making that calculation, if you have your LTV better than what the lender is given, then you know you have enough equity in the property where you can make your refinance possible. And lastly, buyers use future estimated cap rates to model the projected return of a property before it's purchased. So that's the whole process of underwriting. So what we'll touch on next is just the sources of cap rate. It is important to have accurate information about cap rate in your market area. Without accurate cap rate data, it's difficult to determine if a property you're considering to purchase is providing a competitive return. So in terms of your best sources of cap rate information, you probably want to start with your commercial real estate brokers. So when you consider brokerages like Marcus & Millichap, maybe CBRE, Cushman & Wakefield, the different brokerages, you can get that type of information from them. And they're a very good source of determining what the cap rate for a particular market is, especially if they're local in that market and work that market. You can also get that source of information, cap rate, from appraisers. You can get it from the internet resources as well. I know realtyrates.com is also, one place that seems to provide good information on that. And certainly, subscription to CoStar will also help you in terms of determining the source of cap rate. Now, there are different types of cap rates, and this is an important piece as well, because most people aren't aware. When you talk to someone about cap rate, most people are thinking of exit cap rate or terminal cap rate, but there are different types of cap rates that we want to be aware of. You have the market cap rate. That's a cap rate that you're getting that at your property on a stabilized cash flow, right? So in that case, you're looking at the property's T12 and the valuation of that property, and you can arrive the market cap rate from that property. There's also operating cap rate, right? And it applies to deals where you will implement like a value add business plan, and in that case, you're going to use the property's NOI, and then you'll divide it by the purchase price and then the capex work that you're doing with the property. So, for example, if you have a 5% market cap rate on a property with stabilized cash flow, you could decide to implement a value add business plan to grow that property operating cap rate to say 7%. Now, if you're successful, then that is substantial capital appreciation. So in essence, what you do in a case like that, you've built a stream of cash flow for 8% cap that you can sell those same cash flow at 6% cap. And that way you have a good delta there. And, that's where you can make serious money in terms of, building that cap rate by your business plan that you've implemented. So we talk about the market cap rate, we talk about operating cap rate, and then finally, terminal cap rate or the exit cap rate. Now, this is a projected cap rate at which you will sell the investment. People normally add a 10 basis point per year for the whole period between buying the property and the whole period in terms of their exit cap rate. So if your market cap rate is say 5%, if you're going to hold this property for say 5 years, then most people will have an exit cap rate of 5.5%, which is adding 10 basis point per year. In today's market, I think those conditions are changing. The market is softening somewhat, and so operators probably are thinking of adding a little more than 10% basis points. So cap rate is decompressing right now, and we just have to bear that in mind as we go along. Cap rate is a very sensitive metric, and especially the terminal cap rate. And so a small change in the terminal cap rate or the exit cap rate can make a huge swing in a purchase price. So when you're looking at a deal, for example, you want to kind of be aware of this metric because it can make or break the deal very easily. So even though cap rate is an important metric, it should not be relied upon solely as the only metric. Most of these metrics will work together. No one is a silver bullet necessarily, but cap rate is certainly a very important one. And for the other metrics that we'll go over, we will definitely have to weigh all together in terms of making a final analysis of whether or not an investment is a good one to make. I'm going to move forward here, and we're going to talk about cash and cash return. The cash and cash return calculates the cash income earned by the property to the cash invested in the property. So if you look at the formula for a cash and cash return, it is the annual net cash flow divided by the total cash invested. So like cap rate, cash and cash return is expressed as a percentage. So the cash and cash return can be based on projections for any future years, but investors tend to look keenly on the expected cash flow in the first year of ownership. Because typically, if you have your cash flow looking good in year one, it normally increases in successive years, probably due to rent increase. So once your year one checks out well, then your cash and cash normally looks better in the progressive years. Cash and cash return is a levered return, so it's an after debt metric, and cash and cash return is used by real estate investors to assess the potential investment opportunities. So how to calculate a cash and cash return? Let's look at a basic example. Let's look at a sponsor decides to purchase an apartment building for $20 million. The sponsor pools $5 million of equity to invest in the deal and then finances the remaining $15 million. In addition to the down payment, the sponsor paid $400,000 in various closing costs and fees for a total equity investment of $5.4 million. After 1 year, the annual rental revenue from the property is $2.4 million. With the mortgage services, including the debt service, total $1.1 million. The sponsor spent another $400,000 on operating expenses. What is the cash and cash return, right? So, things like this seems maybe a little bit complicated. A lot of people don't like math. I totally understand that. I happen to like math, but certainly, you want to start wrapping your mind a little bit around, what it takes to make a good decision. Now, there are tools and models out there that can help you for sure. And, there are different, underwriting models and Excel spreadsheet that can help you. So all these you don't have to do, by hand necessarily, but would like to just highlight this example to show you how the cash and cash return really works. So from what we just read in terms of the question, first we want to calculate the annual net cash flow. And the annual net cash flow is the total gross revenue minus the expenses. We see there that the total gross revenue is $2.4 million. And what we want to do, we want to take out the expenses associated with it. And the expenses, it would be the mortgage services of $1.1 million, and then the sponsor spend another $400,000, which makes it up to $1.5 million. So then you have your annual cash flow at $900,000. Well, the cash and cash return by the formula that we mentioned before is the annual net cash flow divided by the equity invested. So that would be the $900,000 divided by $5.4 million, which is 0.1667. And we know that it is expressed as a percentage. So that would be your cash and cash return in this particular situation would be 16.67%. So the property total cash flow is 16.67%. This would mean that the property's annual profit that year will be 16.67% on the initial amount of money that you invested. We're going to just jump on to the other few metrics, and then we kind of open up for questions. Let's take a look at the equity multiple. Equity multiple is another investment metrics in the multifamily syndication space that you will hear about. So if you go to someone who is doing a webinar or doing a presentation on an asset that they're trying to raise money for, this is also a metric that you'll hear about. They'll tell you what the equity multiple is that they're offering for the property. So some may say 1.8, some may say 2.0, some may say 2.5. So the equity multiple is going to vary based on the investment opportunity that is presented to you. So you have to get an idea, or one should get an idea as to what that means. So the equity multiple is defined as the total cash distribution received from an investment divided by the total equity invested. So this metric is a measure of the total cash return on the asset over the entire whole period of the investment. So the equity multiple is the total cash distribution divided by the total equity invested. So if we're going to look at another simple example, if the total equity invested in a project is $1 million and the cash distribution received from that project is $2.5 million, what is the equity multiple? Well, since we know the equity multiple is the total cash distributed over the total equity invested, it would be $2.5 million divided by that $1 million. So here we have an equity multiple of 2.5. But what does an equity multiple of 2.5 mean? Well, first, an equity multiple of less than 1 means that you'd be getting back less money than you invested throughout the whole period. And what the whole period is like the period of time that you've held the asset. So you want to know that you're getting an equity multiple greater than 1.0x, right? And this means you're getting back more money than you invested. So in our example, an equity multiple of 2.5 simply means that for every $1 invested in the project, an investor is expected to get back $2.5 or $2.50, and that includes your initial investment of that $1, right? So it begs the question, what is a good equity multiple? Well, the answer, it depends, right? Determining the value of an equity multiple often relies on comparison to other similar investments. So if you were to compare this investment we just spoke about with an equity multiple of 2.5 to 10 other similar properties or investment and find that none of the other investments have an equity multiple of more than 2.0, then in that case, this investment would clearly be your best options, right? So you really have to compare what you're getting as an equity multiple for that investment to other similar investments in the area. we can touch on a few other metrics here, and we'll probably try to get through this pretty rapidly, and so we can answer any questions to the end. One thing another metric that you will see also is DSCR. DSCR stands for debt service coverage ratio. DSCR is a key metric of a company's ability to repay its loan or take on new financing, right? And the way you calculate DSCR, or a formula for calculating DSCR, is the annual net operating income divided by the annual debt service. So DSCR greater than 1, it means that your business has enough income to pay its debts, right? Typically, you'll have lenders looking for a DSCR of 1.25 or better. And a DSCR of 1.25 means that your business makes 25% more income than it needs to cover its debt. The higher the DSCR is, then the more income you have over what's needed to pay your debt, and that's a good thing. So you want to look for a DSCR of a minimum of 1.25 if you want to thinking about investing in a particular property, just so that you can have that investment work best for you. We're going to touch also on internal rate of return, and this is probably the most common metric used by investors, right? The IRR, internal rate of return, is an annual rate of growth that the investment is expected to generate. So for multifamily syndicators, most operators tend to solve for an IRR of 15% or better for their investors. A higher IRR typically means a higher return on investment. So you want to find something that's at least 15%. An IRR takes on both the timing of the cash flow and the magnitude of the cash flow into account. So the IRR is sensitive to the whole period. So it's very, if I present to you two opportunities, that has an IRR of 15%, it will be very difficult to decide which one is better for you, right? Because since IRR take into consideration the whole period, if you hold a property for a shorter period of time, right? So for example, if you buy a property, you plan to sell that property, say in 5 years, and you get a certain IRR calculation there. If you actually exit the property in say 2 years, then you'll see that your IRR jump up significantly, right? So not all IRR are created equal. So you can't just look at IRR as the only metric and not look at the whole period and what's involved in it. Typically, if you have a 10-year hold on an investment, your IRR is best probably about year 3 or year 4. You'll get the highest IRR return during those whole period. But you should be reminded that the shorter the whole period for your investment, it will boost your IRR significantly. So it's just a metric that you have to just keep your eye on. Let's take a peek at the AAR, which is a average annual return. I know there are a lot of acronyms being thrown out here. That's another thing, especially if you're a new investor. You want to probably take your time to educate yourself before you get too involved, especially in the multifamily space. And again, I'll just throw a plug in here that you have a great opportunity coming up November 18th, 19th, and 20th. We have a virtual summit coming up. You can go to cfcsummit.com, cash flow champs. So those are the abbreviations, cfcsummit.com. It is free. I mean, we have the best lineup of speakers in the country, and it's going to be free for you. Well, it's not free for us. We're paying for it, but it's free for you, the listeners. You can absolutely get there and get a lot of information for 3 days, just information packed with the best speakers in the country: Dan Hanford, Trevor McGregor, Jake and Gino, Rod Cleef, Neil Bawa, Rob Beersley, and many other speakers. If you go to cfcsummit.com, you'll see the rest of the lineup of speakers. We're touching on these today just to let you know that that it is best to get educated so that you can make an informed decision when it comes to buying in the multifamily space. Not just for syndicators. It's not just the syndicators or operators who should be informed. We believe that an informed investor is the best investor because they know how to make good decisions. So if you're thinking of investing in one of our opportunities that will be coming up as a limited partner or an LP, where you can passively invest your money and you can have us manage the property and you get returns, then it's good for you to know what we're talking about here today in terms of these different metrics. So let's take a quick peek at the AAR, average annual return. It is a simple equation used to calculate the average amount of money an investment earns each year. So AAR is calculated by taking the total ROI. Here goes another metric. Well, not a metric, but well, ROI is return on investment. That's an abbreviation. So that acronym is ROI, return on investment. So the AAR is calculated by taking the total ROI and divided it by the number of years of investment, right? So for example, let's say that you invest let's say $100,000 in a syndication deal, right? And the total ROI provided to you is $64,000 over 4 years. What would be the AAR on that? So it's simple. The average annual return there would be the amount of money provided, which is $64,000, divided by the number of years involved. And if you divide that, you probably will get $16,000. So in terms of AAR and IRR, they're totally different metric. But one of the most notable difference between them is that between the AAR and the IRR is that the IRR take inflation and the whole period or the time of holding the property into consideration. So if you look at a AAR return on a property and an IRR return on a property, you will see that the IRR tends to be lower than the AAR because it's a more realistic measure of return. We're going to touch on the last metric for today. Hope you're still awake. And I know we touched on a few here today, and just bring it home. So I'm going to touch on the yield on cost. This is not a metric that's very common in at least not a lot of people talk about it, but it is a very important metric. And so we just want to touch on it here today, just very briefly. It's similar to the property's operating cap rate. But the reason why this metric is good is that it is unlevered and it's untrended. By untrended, it means that there's no rent growth calculations taken into consideration when you're dealing with the yield on cost. And it's also unlevered, meaning that there's no mortgage necessarily associated with it. So it's calculated mostly on stabilized assets. So with the yield on cost, it is what you do. You take, if you're gonna renovate a property, for example, and that property is now renovated, the business plan has been executed, and now you're getting constant income from the property. What you want to do is the yield on cost would be your stabilized NOI divided by your cost basis. So the cost basis would be your purchase price plus your capex, right? So the yield on cost is your stabilized NOI divided by your purchase price and the capex combined. So the yield on cost metric is considered by many to be a superior metric because it is difficult to manipulate. It does not take into consideration rent growth projections or exit cap rates or financing assumptions. So it cannot be manipulated very easily, and so it's tend to be a more reliable metric for a lot of operators and people who are evaluating real estate deals. So with that, that would be the end of my presentation today. I want to thank you for your time that you have invested here today. I know this is not the sexiest of topics, but certainly we think here at Cashflow Champs that an educated investor is the best investor, and that's why we take the time to go through this. This is not something that you're probably gonna get overnight. I mean, but certainly just want to kind of let you be aware of some things. Some people out there may already be familiar with this and be very in depth in it, but we want to make sure that the passive investors in particular get an opportunity to at least do some more research on this type of information. And at least when you hear the term, you're just not hearing it at a webinar presentation where you're being asked to invest, but you already have a good idea what these entails and that you can make an educated decision in terms of your investment. So I want to thank Advanta IRA again. I want to remind the audience of the virtual summit, multifamily summit that's coming up. November 18, 19, and 20. It's absolutely free to you. Grab your tickets today, and limited space there. So make sure and go ahead and grab your tickets. And we have the best speakers. Like I said, you have Dan Hanford, Trevor McGregor, you have Jake and Gino, you have Rob Beersley, you have Neil Bawa, you have Rod Cleef, you have guys who have been in the industry for a long time, very seasoned and very experienced. So whether you are thinking about getting into multifamily real estate or you're a seasoned veteran, we will have something there for you. So with that, Corey, I want to turn it back over to you. And again, thank you to you and also to Advanta IRA for having Cash Flow Champs here today.
All right. Well, thank you very much, Paul. I mean, this has been some really, really insightful and awesome information. Your examples provided and kind of going through really some case studies yourself on how to understand these metrics, I'm sure will be very helpful for our audience. Let's go ahead and let me jump the slide deck back to the slide with both of our contact information. And then I'll start with the questions we've got here from our participants, just kind of posing them to you and having you assess and address those accordingly. So here we go. All right. So the first question here, can I make tax-free IRS 1031 exchange investment from other than a prior retirement account? Who do you use as a qualified intermediary for 1031 exchange? For that question, at least in my part, I will follow up with that person offline and provide them some 1031 referral sources. Paul, do you guys deal with 1031 exchanges into limited partnership opportunities? And do you have an intermediary that you would reference or recommend?
We do deal with 1031 exchanges. Mostly we deal with exchanges that are $1 million or more. We do have reference as well for intermediary that would like to just get a person's contact information and share it one-on-one.
Perfect. Yep. So for that individual, I'll reach out from Advanta's side. If you want to learn more from Paul's side, take down his contact information, shoot him a message, and he'll be able to interact with you further on 1031 topic. Next question here. How many multifamily transactions has your group gone for full circle on and exited?
Well, just a little bit about our group. Our group is a more newly formed group. Earlier this year, we come together. We have 4 partners in Charles Seaman. We have Ryan Murphy. We have Prashant Kumar and myself, Paul Sr. And we each have been doing multifamily syndications for a different period of times. Overall, in the group, we have 8 full deals that we have gone full cycle on to date.
Perfect. All right. Thank you very much. Next question here. Should I believe the syndicators' claim on their historical performance? Every pitch I've been to, the syndicator shows IRR, cash on cash, ... for past investments. However, there is no governing authority assessing that these financial statements in a pitch deck. How do I verify the veracity of the syndicator's own assessment of their own financial performance?
Well, that's why we're having this webinar today, right? We believe that
exactly.
An educated investor is the best investor, right? And I think that, and part of what we're trying to push is the education piece, right? And so we believe that not only the operator should be the one who can evaluate a deal. We believe that we truly believe that the passive investors should learn and take the time to analyze the deal properly. There are different models out there that you can work with, investment models that you can download in terms of analyzing a deal. So you yourself can start doing that. Here's one big thing too I want to make mention of. We so believe in educating the passive investors that every Saturday at 4 p.m., one of our managing partners, Charles Seaman, holds a free underwriting session. A free underwriting session at 4 p.m. Eastern every Saturday. You can definitely get that information. There are a lot of people who jump on to learn about underwriting, to make analysis of deals. So you're welcome to that session. And You have my contact information here. You can always reach out to me. We can get you the link for that. But certainly educate yourself. Come to these sessions like that. It is free. We're trying to educate the public. And when you do that, then you don't have to worry about what the operators are showing you in a pitch deck. All you have to do is ask them for their financials. You underwrite the deal yourself. You make an evaluation and see whether or not this deal holds water. Because I'm telling you, if you look at just the IRR, the AAR, the equity multiple, or whatever it is you want to look at from just looking at a webinar, it's very hard to know what those numbers represents. Like I said in the presentation, for example, a small change in your terminal cap rate can make a significant difference in terms of the valuation of a property. I mean, not talking to the tunes of millions of dollars, right? So you want to make sure that you get a chance to educate yourself. And I think the best way to do it in terms of evaluating the deal is to start attending a session with one of our managing partners, Charles Seaman, Saturdays at 4 p.m. Eastern Time.
Perfect. Thank you very much. And I know I mentioned briefly, I actually got connected with you, Paul, by way of Charles. I've been going to his monthly in-person event over in Charlotte for close to a year now. And I've actually had him on an Advanta webinar a few months back as well. So just in his own right, he is a great educator that I would definitely recommend if you're interested in that underwriting call on the weekends. Or any of the other educational content. You could check out Advanta's YouTube page for the webinar I did with Charles a few months back. Next question here, what is the cash on cash metrics and how is it used? I'll kind of skip that on your behalf. That was covered on slide 26 of the deck. So I'm sure that person probably just posed that question before we got that far in the webinar. Next one. Of the ones that you have exited, I'm assuming this means deals exited, how close were the final return figures compared to the pro forma of projected returns? Really for that, if that person's looking into cash flow champ specifically, they should probably reach out to you directly to facilitate that conversation offline, I would say. I mean, feel free to answer as you see fit, but I would definitely implore that person to take down your contact info and reach out to you one-to-one.
That would be the best way, correct.
Oh, good. Any good books you recommend on understanding multifamily investment metrics? I would recommend reviewing this webinar in its entirety if there was any specific slides that or portions that Paul mentioned that you'd like to dive deeper into. But any books that you would recommend on this topic specifically, Paul?
Yeah, the two that comes to mind is one is the Definitive Guide to Understanding Multifamily Acquisitions by Rob Beersley. I would like for you to consider that. That book is very good in terms of underwriting. A second book I would recommend, maybe more, not so, probably more if you're just beginning, because it has the concept very understandable, is Whatever Real Estate Investor Needs to Know About Cash Flow. And that is by Frank Gallinelli. So I would recommend those two books.
Perfect. Thank you very much. Will you be sending the deck to us in an email? I can confirm that if you were registered for this webinar, you will be receiving a copy of the video recording. It is just to be determined. Paul, if you're okay, sometimes we do turn the deck into a PDF and send that out. If you're comfortable with that, I'm happy to facilitate that on my end. I just need to obviously get your approval before I facilitate that at all.
Oh, for sure. Whatever material we can get out there to educate the public, I'm all for it.
Okay, so that answers that. I will be happy to turn the slide deck into a PDF, and upon receiving requests, happy to send that out. For the individual that posed that in the question box, I will take down your info now and make sure I send it to you, so no need to follow up with me directly. But anyone else interested in receiving a PDF of the slide deck, please shoot me an email and I'll be happy to send that over to you. Looks like we just have 2 or 3 final questions here. This one's a little bit lengthy, so let me make sure I enhance my screen size so I can read it. These are going to be the final 2 coming at us.
Okay.
It seems like 2 identical equity multiples can have a very different values as deals. You could have 1, high cash flow, and then a sale price close to the purchase price, or 2, low cash flow, but then a large gain on the sale. Since a dollar is now worth more than a dollar in the future, all else being equal, it seems like the first deal would be better than the second, even if both have the same equity multiple. Am I understanding that correctly?
Whoa, that my brain couldn't grasp all that. My brain couldn't grasp it all at once. Give that person my information. We can talk offline on that.
Perfect. Understood. Uh, and then the final thing here, please reiterate the importance of yield on cost. What would be considered a good YOC?
Well, the yield on cost is just one of those metric that is very hard to manipulate because it doesn't take into consideration rent growth and things like that that other metrics do take into consideration. The yield on cost is your stabilized NOI divided by your cost basis, which is your just your purchase price and your capex in case you did any capex work on the property. So for that reason, it's a harder metric to manipulate. You can't raise rent projections, by 5% or 7% in a case like that. So like you would do that affects other metrics. So just a harder metric to manipulate, and therefore tends to be a more reliable metric for at least most investors consider to be a more reliable metric. But in itself, you don't take it by itself, so you still take it in conjunction with other metrics as well. But if you're going to choose the holy grail of underwriting, you probably want to go with the yield on cost.
All right. Well, Paul, thank you again so much for doing this webinar with me. It's very invaluable information you've shared with our audience here that I'm sure they will, be following up with you for your summit that's going on next month, as well as some of these other questions that have been posed in the question box. So I greatly appreciate your time, your energy, and your efforts that went into preparing and facilitating this. And thank you so much for all the education you provided. Everyone, thank you so much for participating, for following along. Please feel free to reach out to Paul directly or myself directly as it relates to interest in Advanta or interest in Cash Flow Champs and the summit next month. Paul, any final closing words from you as we get this wrapped up?
Just want to say thanks to Advanta IRA and in particular to you again, Corey, for hosting Cash Flow Champs here today. We really appreciate it. And to the audience, our gift to you again is that free ticket to attend the Cash Flow Champs virtual summit that's coming up. Please go to cfcsummit.com.
All right. Well, thank you so much. I'm sure we'll be in contact soon. I know that I've also made a connection to hopefully have you as a guest on our podcast upcoming soon. So we look to continue to network and do some great educational materials and content with Cash Flow Champs. And everyone have a great rest of your day, and we'll catch you next time. Thank you.
Thanks, Corey.